Hello and welcome to a very special edition of the Life by Design podcast. Joining me this week, as always, is Doug Walters.
Hello, Jay. How are you?
Fantastic. Thank you, Doug. And so this is going to be a little bit different than what we've been doing. We've done one of these so far on the Life by Design podcast, and this will be our second one. But this is our quarterly wrap up that's going to mostly focus on what happened in the market and in the news.
Right. Yeah. So we've ended the second quarter. So we're going to look back, talk about what the major news was, what the major points were for investors, and then we can do a little bit of looking forward to the third quarter.
Yeah. So what happened during this quarter? I mean, that's the easiest question, right? What happened during the quarter that we should look back at?
Right. Good question. And we're going to start where we have spent a lot of time this quarter talking, which makes sense, which is on inflation.
Yeah.
So inflation has been range bound. So just to rewind a little bit, the Fed wants to see inflation falling down to 2%. 2% gives it some comfort that they can lower interest rates. Lower interest rates is good for the economy, stimulates the economy, but they don't want to overheat. So they're going to wait until they see inflation coming down. But inflation really has been range bound for the last year, between 2.5% and 3%. And that same story persisted in the second quarter. So that's sort of the first main point and sort of overarches everything is that inflation remains sticky in that 2.5% to 3% range.
And so inflation is basically, to like break it down for me, is just how far your dollar can go.
Right. What do things cost compared to how much they cost last year?
Okay.
So when we talk about 2% inflation, that means things are 2% more expensive than they were last year.
Okay.
So that's what the Fed is aiming for. That's a healthy economy. A little bit of inflation is good. Too much is not good.
Okay, perfect. So that's the inflation in Fed. And then, so what about like U.S. equities? What were we looking at there?
Yeah, so there was a big seesaw. So if you recall, we exited the first quarter with the S&P 500 down around 4% or so. And then in the beginning of the first quarter, we saw a significant decline. So in the the second quarter, we saw equities falling, double digits, so 10, 12%. So we had a real rough start to the second quarter, followed by a consistent grind upward, bouncing 25% off of that bottom. So that ended, if you're thinking about U.S. equities, the S&P 500, we ended the quarter in positive territory for the year. So we're up on the year despite the significant decline that we saw early on.
Yeah, and I think that's something, you've been hammering home with me. And as we talk about this and as the podcast goes on and we have more conversations, right, I can see it in real time, which is whatever happened during that week, the news flavor of the week, right, that drove some of that decline, the market then readjusts and things happen. And then some other news item comes out that's positive, and then that, it readjusts the market. And so for me, it's really interesting to have this quarterly perspective and go, oh, right, I do remember that week.
Right.
And now that we've got 3 months, into the quarter, I go, okay, like longer term, we look at it and it rebounded a little bit.
Right. And it's interesting. I think it's a good lesson. It's a good point. Thinking back to that first week when markets had fallen quickly, 10%, it would have been very easy to get nervous, to take some money out of the market. It's just a reminder that you never know what is going to happen. Did the news flow dramatically change from that first week to the rest of the quarter? Not really. We're still uncertain about the impact of tariffs. It was really just a market sort of maybe just getting comfortable with the idea that the tariffs are bad, but are they really going to be in play? Is it more of a marketing or not? Is it more of a negotiation tool? So just it seems investors got a little more comfortable with that tariff narrative. So there's nothing dramatically changing on the economic front. So you never want to react sharply to significant declines. In fact, you want to take advantage of them. That's why we institute opportunistic rebalancing. We're looking every week for these moments where there's big moves, where we can systematically sell high and buy low. And that was one of those moments.
Yeah. And I think for those of you listening to this, we also are putting out our quarterly rundown from our CEO. And one of the things I've heard him say over and over again is it's companies' jobs to get their stocks back up, right? So like they're working on that. That's their job, is to make sure their stocks are doing well for their for the investors, for us, for anyone investing in them. So we're, whether or not the news changes, they're working separately in order to make that happen too. So
right. Yeah. And you can see some of the ingenuity of that over the last few months. Again, on that tariff front, you heard stories of, Amazon shipping everything to Canada and storing it just across the border, waiting for the right moment to bring it across. Like there's a lot of ingenuity out there. Companies are there to make profits, and they're going to do what they can to do that.
Right. Yeah. Okay. So that was kind of U.S. equities. Then I've been hearing a lot of talk about currencies and how they're affecting the market as well. I know that the dollar, I've seen some stats that the dollar's down a little bit. So how does that affect not only the market, but what we do as well?
Right. So currency is a source of risk and volatility in a portfolio, but it's a source that we want some of, and we tend to get it in the form of exposure to international markets. So international equities, if we take a look at that market, has done incredibly well this year. Part of that is the underlying market, and part is, as you say, currency. So U.S. dollar weakness will generally result in an increase in international equities for U.S. dollar investors.
Okay.
So let me just unpack that a little bit.
You saw the look in my eyes just go.
All right, so let's take it quarter by quarter. So in the first quarter, U.S. market was down 4%. We already talked about that. International markets were positive, let's say roughly 4% or so. On top of that, there was a 4% decline in the U.S. dollar versus a general basket of currencies. Okay. So our international equities are exposed to that basket of currencies, and they're earning their dollars, not in dollars, but in euros, in yen, whatever the currency is. So if our US dollar is weakening relative to those currencies, as an investor in those companies, we're benefiting from exposure to the euro, from exposure to the yen.
Gotcha.
They become more valuable relative to the dollar.
Okay.
So just to quote some numbers, so S&P 500 down 4% in the first quarter. International developed up about 3% on the quarter in local dollar terms, factoring in the weak U.S. dollar. To us as U.S. investors, we got 7% return.
Oh, wow.
From developed international. So U.S., S&P 500 down 4%, our developed international up, let's say, roughly 7% in the first quarter. So let's fast forward to this last quarter, second quarter. Different story with U.S. equities. S&P 500 up 10% plus on the quarter. International equities up, I'm going to call it 5%. So they underperformed the U.S. in local currency terms. Add in the weak U.S. dollar, another 7%. Our international developed equity holdings were up 12%. So international, once again, outperformed domestic equities, but most of it this time was the U.S. dollar. So the underlying markets were weaker, but the U.S. dollar being weak helped in those returns.
Got it.
Does that make sense?
It does. And so I think it drives home kind of this, for the listeners, if you've been listening to our conversations, diversification, evidence-based investing, right? It just drives home those conversations of saying, okay, yeah, so being diversified and not knowing that any of that was going to happen, but having something in international proved positive for you.
Right. Currency is a form of diversification. We generally don't invest directly in currencies, but we do indirectly through international holdings, and we like that addition of diversity to our portfolio.
Yeah, I think it's great. So that's kind of talking about the quarter. As we're looking forward coming into the next quarter, we've got a couple items that are coming down the pike, which is the new bill that was passed, which is going to increase debt. And then we're also looking at some tariff uncertainty as well.
Right. Yeah. And we saw the impact of that in the last quarter. Even though the bill hadn't passed until just after the end of the quarter, we did see, particularly in the Treasury market, the impact of the expectation of this higher debt burden. So we saw particularly long-term Treasuries. These are debts that the U.S. government is issuing. We saw those yields rising, and when yields rise, that means prices are falling. So that was one of the weakest asset classes for the quarter, were these long-term Treasuries, and that makes sense given the expectation of this higher debt burden. The plus is for investors or holders of those long-term Treasuries now is you're getting a higher yield going forward, but you had to pay the price in literally the price coming down this past quarter.
Yeah, and so also with there's been some news on tariffs, so there's more uncertainty to come with that, right?
Yeah, as we start, I guess, transition to thinking about looking forward.
Yeah.
Again, we don't predict, but it's pretty obvious there's going to be, a lot of uncertainty with the tariff situation. Is that going to lead to the Fed to have to, is the Fed going to be able to cut rates or not? These are questions that have lingered for the last quarter. They're going to continue to linger in the quarter ahead. In this environment, it's diversification is critical. We want exposure to those international markets. We want continued exposure to gold. We want U.S. large cap. We want small cap. Really hammering home the importance of diversification, and then being able to take advantage of any significant market moves with that opportunistic rebalancing, looking every week for any asset that might have moved significantly one way or the other and taking advantage of that.
Yeah, I think that's all great. And I think that's a good recap of the quarter and what we're looking forward to. And join us as we continue my journey on the Life by Design podcast and learning about markets and all the words that Doug throws around and getting definitions on that. So thank you, Doug.
All right. Thank you, Jay. Take care.